is one of the nicest guys I know, but almost as importantly as that, he's a really, really good technician. I particularly love his doji best friend and his doji at the top patterns. Today, he's going to talk to you about how to produce profits from wedge patterns. And normally, I'll bring him on and have him talk a little bit since he can't hear me at all, but I can hear him. It might be a little bit of a weird transition. I'm going to go ahead and turn this microphone on, get him the organizer as well.
Jeff, can you hear me?
I can hear you. Can you hear me this time?
Yep, I found the right button to, so I'm back on.
I do that myself. So there you go. It's all yours. The floor is yours, Steve.
All right. Thank you, Jeff.
All right.
Welcome, everybody. Always like to do or work with Metastock. Jeff and I, as he's mentioned, have been working together for years. And I consider Metastock probably the best charting service out there. The thing that I tell people that the big negative about Metastock charting service is that there are so many good things to use on this system that you'll never be able to get to use them all. There's just too many of them. But whatever system you set up, you've got more information or more indicators than you ever need with Metastock. Jeff and I have been working together for quite a few years because we've put some of our automatic signals into the Metastock system. I started using candlesticks probably, I hate to think, about 40 years ago, and kind of narrowed down where you can take advantage of the candlestick signals and patterns, which we've already put into the Metastock system so that they identify them for you. Now, I use candlesticks as my number one criteria for analyzing anything. If you've already got a successful technical trading program, if you overlay candlesticks on top of it, the amount of information will be dramatically improved. You'll be able to see everything much more clearly. Now, we do have a question session section. If we're going along and you've got a question, feel free to type it in there. I'll answer as best I can. But what we're going to do today is work on wedge breakouts. But that's all part of analyzing the different patterns that are available visually with candlestick analysis. If you understand that candlestick analysis is merely the graphic depiction of what's going on in investor sentiment, that is the most important factor as far as seeing where prices or when prices are moving. My number one statement is prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick signals and patterns are merely the graphic depiction of what's going on in investor sentiment. There's a simple adage on Wall Street: if something doesn't work, it disappears very quickly. Candlestick analysis has been around for 400 years. Most people are just learning how to use it, not because of the quotes that you see when somebody's showing you a new trading program that they've just discovered the new secrets of how to trade successfully. There's no new secrets in candlestick analysis. It's showing what price movements do based upon human nature. All we're doing is learning how to analyze them. So where do breakouts occur? And that's why we're looking for the new investor sentiment. And it's usually going to be at support and resistance levels. Now, it doesn't matter what you're analyzing. I'm going to show you what my charts look like very quickly. There's the 200-day simple moving average is the red chart, or the red moving average. The blue moving average is the 50-day simple moving average. Now, the reason those two are on our charts, a lot of people say, well, why don't you use the exponential? Don't they work better? We're not watching to see or use those moving averages as our decision making. we're watching to see what everybody else in the world, every major money manager in the world uses those moving averages to make their decisions about their portfolio. We just have the visual advantage of seeing what's happening at those levels. It's very simple. There are 12 major signals out of the 50 or 60 candlestick signals in the candlestick universe. There's 12 major signals that once you learn those, you've got two major advantages. You're seeing exactly when there's been a major change of investor sentiment with a signal, and the Japanese race traders after 400 years have been able to describe what the investor sentiment was that created those signals. So not only do you not only recognize or visually recognize a signal reversal, but if you understand what caused it, you've got the grasp of what moves prices much better than somebody that's been trading in the market for 40 or 50 years. This is an evening star signal, a big up day, a day of indecision. The third day closes more than halfway down that last big up candle. This is what we call a morning star signal. Big down day, day of indecision, then a big bullish day. This is what we call a doji sandwich, where you have a big up day, a day of indecision, and this day, after a day of indecision, kind of a doji day, we have a very simple rule of the doji. It's going to move, prices are going to move in the direction of how they open after a doji. With that, we know if they open this positive, the magnitude of this candle is usually going to be the same magnitude as this candle, which gives us instant information. We can be buying immediately, number one, and we already can calculate what the price move will be, and we know that it's broken what we call the T line. That's this black line. The T line is the 8 exponential moving average. It has a very simple but extremely high probability result. That if you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. That alone will keep you from being whipsawed in and out. That alone will keep you from your emotional trading, where thinking, man, I've got a good profit, I better take my profits, versus letting the chart tell you where your prices are moving to. I use stochastics. Very simple concept from the Japanese race traders. If you see, I'm sorry, I needed to further describe this, that if you see a morning star signal followed by a doji sandwich or a morning sandwich, we call that a McMuffin. First of all, we know that the results of a morning star signal is probably there's going to be more upside. We also know that if you see a doji sandwich, the probabilities are going to be more upside. When you see the combination of those two, the probabilities of more upside are extremely strong. This is what we're looking for, is the breakouts. Notice how this is what we call big fry pan bottom, breaking out. And I always use this rhetorical question. When we're using candlestick analysis and we can recognize the setups like a J-hook pattern, do we always buy at 15 and sell at 45 2 days later? Definitely not. But the probabilities of being in a situation where that occurs is greatly enhanced when you're using candlestick analysis. So it also provides exact timing for entering a trade. If we see a pullback like this, right smack dab to the 50-day moving average, this is a bullish harami. Bullish harami in Japanese means pregnant woman. There's her body, there's her little body sticking out, or her little belly sticking out. And it's one of the 12 major signals, and it basically tells you the selling has stopped. We know very simply, if it opens positive the next day, we want to be buying immediately, because not only has it told us that the selling has stopped, but the buying has come in with great strength. Stochastics are 12-3-3 slow stochastics. So again, there's a bullish harami, right smack dab on the 50-day moving average with stochastics in the oversold area. They gap it up the next day. We can be buying immediately. Fry pan bottoms are ones that are very easy to recognize. A fry pan bottom is just a big rounding bottom that you couldn't trade one way or the other. until you get back to the breakout level. And notice what they did here, a little indecisive day, a doji day, and a gap up. What did that tell us about this resistance level, especially coming out of a fry pan bottom? But there's a new dynamic, you're probably going to have a strong price move. So anytime I see this setup, I'm looking to be buying here. And if it gaps open, what's it tell us about this resistance level? Number one, this doji gap up is what we call your best friend, one of the patterns that we have on Metastock. We call it your best friend because there's two elements to this that are extremely powerful. One, it's going to give you an extremely high probability that you're in an uptrend. And two, the magnitude of that uptrend is going to be relatively strong. So if you see a fry pan bottom followed by a best friend breakout, that's the exact information you want telling you that that pattern has broken out. Now, the difference between a signal and a pattern is you want to see a signal, like a bullish engulfing signal in the oversold area. A pattern, if you're identifying it, will usually break out when your stochastics are already up in the overbought area. So this is what we're looking for. That fry pan bottom breakout telling you there's a new dynamic. Now, I also have on here this chart. The candlestick charts are the graphic depiction of everybody buying and selling during a specific time frame. This could be your 1 minute chart, your 5 minute chart, your 30-minute chart, your weekly chart, your daily chart. It doesn't matter. They're all going to look exactly the same. And your criteria as far as the moving averages are going to be the same. The classic pattern is the fry pan bottom. And what do we expect coming out of a fry pan bottom? A very strong price move. Then what do we expect on an indecisive pullback? A J-hook pattern. And what's the prerequisite for a J-hook pattern? A strong price move followed by indecisive trading, usually supports right back on the T-line. And the next move, if this is wave one, wave three is going to be the same magnitude. Now, these are just very simple observations of identifying candlestick patterns and signals that have been identified for the last 400 years by the Japanese rice traders of how human nature works with an extremely high probability. The slow curve is another high probability trade. Look at the little slow curve. We know the expectation on a breakout. Usually a very strong, powerful move. A slow curve, especially right here at a major resistance level. Look what started this one out. There's our doji sandwich breaking out into new territory, giving us a strong price move. Slow curve. This is what we call a bobble breakout. Notice how it hit the resistance level, pulled back, and then bobbled in there and came back up through with a slow curve, creating that slingshot effect to the upside. The best friend pattern is that doji gap up. This is probably one of your top trading setups, because there's your day of indecision. Remember, a doji is where they open close at the same level, telling you there's indecision between the bulls and the bears. When they gap it up, this is what I also call convergence analysis, which is look at all the pieces of evidence we can put on here that this is going to be a strong trade. One, we have a doji kind of at the end of a wedge formation. Got the 50 acting as support. You got this downtrending channel. You got a doji right out at the end. And there's a very simple rule of the doji. They're going to move it in the direction of how they open it after a doji. Well, the fact that they gap it up also tells us they've gone or moving away from the 50-day moving average. They've broken this downward resistance level. They did it with a best friend signal off the 50. That tells you there's a brand new dynamic, which is usually going to be relatively strong. By fry pan bottom, look where the breakout occurred. They gapped it up through where this pattern started. Then look what went flat. And this is one of the just simple observations. Look what happened when it traded flat for 2 or 3 weeks. What was the last signal at the end of that flat trading. The doji. What do we know about the doji? It's going to move in the direction how they open it after a doji, and if they gap it up, there's your best friend signal telling you there's more upside, telling you they broke through all this level and they never could close back below the T line. So identifying a wedge formation is much more easy because of the graphics of candlesticks. First of all, forming a wedge formation is utilizing the support and resistance level, and that trading range starting to compress. So the support and resistance level usually can be identified by drawing a line between the tops and the bottoms. And then there's our bullish engulfing signal right on the 50-day moving average. Notice what this trend didn't do. Didn't come back down here before the next buy signal. That told us there was probably more buying strength versus just going back to the bottom and coming back up. So when it broke out, you knew you had a new dynamic and a strong price move. Anytime you can see this wedge setup, which is simply just drawing a line down through the tops, where every time it got up to a top, look at our evening star signal. Every time it got down to the bottom, you started seeing dojis and bullish confirmation. This is not rocket science. Human nature works the same way time after time. So whether you're trading wedge formations, flag formations, Fibonacci retracements, anything that you're trading, you're going to have a much more clear visual analysis using the candlestick signals, because they're going to give you a heck of a lot more information of what's going on at major support and resistance levels. So the fact that they came up through this downtrending channel, this is also what we call a T-line crunch. Notice how the T-line, they couldn't close it below the T-line, and the T-line crunched the price right up through the 50 at resistance level. That told you the bulls were still there with a lot of strength. Resistance, support, and visually you can see that it's compressing, and when they gap out to the upside, what do you think's happening now? There's going to be a lot more upside. The T-line is the 8 exponential moving average. Again, very simple. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. There's a caveat to that. That the further away you move from the T-line, the higher the probability it's going to come back and test it. So this was not moving that far away, but you had an evening star signal. But let's say that occurred up here and your T-line was down here and you saw a sell signal. The probabilities of now time to take profits become that much greater. Again, support and resistance, we're looking for the breakout. So this shows exactly when you want to start buying based upon seeing a pattern like a wedge breakout. So again, forming the wedge, you have the support and resistance and the compression level. So you've got declining wedges, obviously, where you can see the tops are coming down and there might be a support level. Where was the time to short? If you can see this, this is where being able to identify or evaluate a price pattern is that much. Oops, did everybody lose sound? Is there no sound? Good. All right. Okay, good. All right. But notice what told us that this might be not breaking up through the upside, going to the downside. This is what we call a kicker signal. This is the strongest of the 12 major signals. It opened here and closed here. The next day they gapped it down below the open of that bullish day and went the opposite direction. They basically kicked the investor sentiment in the opposite direction. Then notice what happened after that. Not only did you have a strong bearish signal, but then you had a doji sandwich, which implied there was more downside. When it broke this level, you knew you had the probability of staying short until you saw a candlestick buy signal and a close back up above the T-line. So lower highs, support level, they break the support level. That tells you the declining investor sentiment finally was heading lower. The T line is the 8 exponential moving average. We call it the T line, or short for trigger line. We had all sorts of names for it, and we decided the simplest was just call it the T line. So if I see something like this, I'm looking for the breakout. So an uptrending wedge still has the same prospects. Notice how they're having a hard time getting through this level. So when they fail and they come back down through here, pretty much tells you that wedge formation has been broken. There's a new trend in progress. All prices move in waves. Wave 1, wave 2, wave 3. Knowing that allows the candlestick investor to take much more advantage of knowing what type of signals are telling you which direction or when wave 3 will be starting. So patterns have expectations. We know if a wedge formation breaks out to the upside, there's going to be a lot more upside. We also know that if we are trading this, we were expecting a J-hook pattern, which is one of the simple patterns that comes up, pulls back, and then wave 3 is usually the same magnitude as wave 1. However, notice where this failed up here. Right here. We had this going on. So that kind of gave us the indication that maybe we don't have a good trend going on, that this is probably going to be moving sideways for a while. Which tells you, yeah, we probably don't want to be trading this until we see something definitive. How common are wedges? I bet you on any given day you can find a wedge somewhere. Now, I usually don't look for wedges. If I was taking profits here after buying down here, and I saw bullish harami right at the 50, and I started buying, and I saw it fail up here, it had to come back out, well, I can see that it didn't get to a new high, and it kind of had a bottom here. So that's already told me that this is probably a wedge, so I just keep it on my watch list, already watching for it. I'm not having to go look for it. I already know there's probably setting up, so I keep it on my watch list. Again, we can see the support and resistance, and we can see exactly what type of signals, candlestick signals, are going on at those levels. So remember, the indecision can be seen by not getting to a new high, not getting to a new low, not getting to a new high, not getting to a new low. But every time it starts coming to this support level, you can see what's happening. There's a bunch of candlestick buy signals going on here. So what do we expect coming back up here? Two things. Either if it fails, it's going to be still forming this wedge, or notice what happened here. We had buy signals, and then this candle actually took us through this resistance level. Then a doji. What's our simple rule of a doji? The price is going to move in the direction of how they open after a doji. Had this opened lower the next day, would that tell us? Well, probably this wedge formation was still in progress. If it opened positive, what was it telling us? It's probably moving positive, with this candle being the same magnitude as this candle, telling us the wedge breakout had occurred. We could be buying right here with great confidence, because there's two elements that the visuals of candlesticks produce for us. One, it tells us the direction, and two, it tells us the probabilities of what is happening. So if we're buying right here, we're expecting another move or a big move like this. On the other hand, where most money managers tell you, cut your losses short and let your profits run, and in the 40 some odd years I've been investing, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Very simple rules with candlesticks. If I had bought this expecting a doji sandwich, a high probability situation, and it closed back down here, what'd that tell me about my breakout? It didn't occur. Close it out, move on to something else. So I'm holding on to the ones that tell me to stay long until I see a sell signal and a close below the T line, and I'm getting right back out immediately of the ones that tells me that the expectation of that those signals and pattern breakout didn't occur. The 8-day exponential moving average is the 8 EMA. They were the same thing. Is it a purple, blue? Oh, the blue line is, this dark line, that's the 50-day moving average. There's a gray line on here, which is the 34 exponential moving average, which also is kind of a secondary support and resistance level. So, oops, I already had this. Notice all the dojis forming on the bottom. We could tell this was the setup, and then there was our doji sandwich breakout. So this creates those obvious entry points, which are extremely good if you're trading something. You know exactly what to be doing at the appropriate time. You don't have to be sitting waiting when there's nothing going on. This told you there was a definite change in this little wedge, and look what was happening. They couldn't close this above the T line. So what did that tell us about our downtrend? More than likely, our downtrend was still in progress. All this is doing is giving you much higher probabilities of a direction and the force of a direction based upon the pattern that was setting up and the signals that told you what was actually happening at the breakouts of that pattern. The T line is this little black line. Yes. So here's my T line. Here's my buy breakout. There's a best friend breakout of a wedge. When was it time to take profits? When you saw a candlestick sell signal and a close below the T line, which would have been down here. But remember our caveat that the further away you move from the T line, the higher the probability it's going to come back and test it. So if I see a bearish engulfing signal in the overbought condition that far away from the T line, I'm taking profits because where do you think my first target's going to be? Back here. Is it going to do a J-hook pattern? We could always figure that out once we get here. Or is it going to continue down? We don't know. Why take the risk? This is telling us we've got a high probability that the sellers have taken control. So when can we be buying this? If we aren't buying right in here, we're definitely buying on the gap up. So if you're trading, what is T line, which is black one? What is T line? The T line is the 8 exponential moving average. And again, of all the technical indicators that you can use out there, Bollinger Bands, moving averages, trend lines, if you just use a very simple concept of seeing a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. Same on the downside. If you see a downtrend, you can stay short until you see a candlestick buy signal and a close back up above the T line. So this gives you the exact time to be buying. Notice our bullish harami right here on the 50, our wedge formation, doji. Then our simple rule, it starts trading positive. The magnitude of this candle is going to probably be the same magnitude as this candle, telling us our doji sandwich is breaking out through this downtrending resistance level. You want to be a buyer. You don't, if you're trading stock, if you're trading options, you don't have to be sitting around waiting to see if it's going to break out. The candlestick signals tell you exactly what's happening at those breakout levels. There's a kicker type signal telling you this wedge formation has broken out. So if you're in the wedge formation, what to do? Well, if I'm in here, I don't want to be trading because I don't know which way it's going. It's at this point that I've got new information that it's broken the wedge with a big bearish candle that tells me there's now a major change of investor sentiment. If I see a little wedge formation, is it time to be buying here? It looked like it, but it failed. Is it time to be buying here? Didn't really confirm. Is it time to be buying here? We don't know. But right here, that tells us a completely different story, that the wedge formation is broken out. Now you can go long. Always like to watch to see when you've got a signal and then a gap up or a gap down through an observable pattern. These are always, so if I'm watching this, if I've got this on my list and I'm watching and saying, all right, I'm going to see whether they break it this way or this way. If it starts trading up here, I'm buying. Again, having this alert based upon candlestick signals, yes, the gap, doji gap up is your best friend. That's what we call that pattern, is your best friend. We'll have, notice this little slow curve gap up. So all we can, or what we're getting the benefits of based upon candlestick signals and patterns, is when there is a change of investor sentiment that we can identify based upon the candle formation. So if it opens here and starts trading up here, what's it creating? It's already creating a white candle. And where is it going? Above this level. We now know what's happening to this wedge. If we're watching this, we can be buying here. Now, do they all move up big like this on that first day? Definitely not. But it puts us in a position to be in situations where the probabilities are pretty strong. We're going to be in those type of trades. So I'm buying here somewhere, or I'm buying on positive trading the next day because of the wedge breakout. Again, a wedge is formed because you can visually see a, oh, Richard, we're only looking at one pattern, the wedge. I think I've got a few more patterns here. Remember, prices move the same way time after time based upon human nature. So the wedge formation is just one of the aspects of how, if you're trading wedges, you get much more benefits using the candlestick signals. If I know my patterns, like a slow curve fry pan bottom, when it broke out through this level, now I've got my trend analysis. I can see when it's time to take profits. I can see when it's time to get back into the J-hook pattern. Or if this is my J-hook pattern and they gap it up through that, I know I've got more upside. When I have more upside and I start taking profits, I watch to see what happens here at the T-line. Here, I guess here is the most powerful analysis of candlestick signals and the T-line. All the other moving averages, major moving averages like the 200 and the 50, all act like magnets. Why is that? Because everybody's waiting to see when a price is moving to or back down to a major moving average. Everybody's kind of waiting to see what it does when it gets there. So they act like magnets. The prices move to those levels. That's because everybody has the 50 and the 200 on their charts. The 8 exponential moving average, the T-line, statistically, you can say that nobody has that on their charts. So I tell people, don't be scared to put the T-line on your chart. The nice thing about candlestick charts is we know the candlestick signals work, or they wouldn't be around 400 years later. So I tell people, don't be afraid to put that on your chart, because the worst case scenario is if it doesn't work for you, take it off. Oh, shoot, I tell people the first time I had sex, I was so scared. But then again, it was dark and I was all by myself. But there's one very powerful concept of candlestick signals and patterns with the T-line. That if candlestick signals are the graphic depiction of what's going on in human nature, and the T-line acts like a natural support and resistance level of human nature, When you combine those two, you've got an extremely powerful combination of being able to analyze price trends. Do you use 34 EMA or 3? I use both of them. The 34 is kind of a good trend, and then the 3 T line, use that when the prices start moving too far away from the T line. The 3 T line kicks in to be more efficient. Let's see. AJ, yes, Metastock. We've already got these on. Yeah, these signals and patterns are already built into Metastock's software. Let's see. Where do you draw your trend line? Highs or close? Just anything that looks like that was a resistance level, whether it was the high or whether it was the body. You can visually see where the selling had started coming in or the buying had stopped. When to take entry? Next day open or previous day? Next day open. Very simple. If I'm buying based upon bullish confirmation, if it opens positive the next day, I'm buying. What I don't want to see is it open down here the next day, because that tells me the bulls aren't there. What's the whole point of identifying a candlestick buy signal? Is seeing that the bulls are still there the next day. I would rather pay up, knowing that I'm being confirmed in my my bullish signal. So if I see this is what we call a scoop pattern. Notice how this is one of the candlestick patterns. Notice how flat this handle is. Pulls back. Then we have, this is what we call a left-right combo, a doji followed by a bullish engulfing. And notice what was happening here, a little scoop. So what do we want to see the next day? I want to see the bulls are still buying, confirming this price move. I don't want to see it open the next day down here, because that tells me the bulls aren't there. Is the blue line? No, the blue line is the 50-day simple moving average. The red line is the 200-day simple moving average. The gray line is a 34 exponential. The black line is the T line, the 8 exponential, and you can see very lightly the 3 T line. And once again, notice when it was, here's something that we don't have time to do, but real quick, if we know that we're moving that far away from the T line in the overbought area, we don't want to wait for it to close back below the T line. We already know we're too far away from the T line. So if I've bought this and I see it trading up here, you can see how far away it is from the T line. I flip to my 10-minute chart and I stay long as the 10-minute chart shows the price is staying above the T line. As soon as I see a sell signal and a close below the T line on the 10-minute chart, I'm taking profits, because what the 10-minute chart tell me? That selling had started. And where do I expect selling to start? That far away from the T line. Yes, stochastics 1233. Do you trade on daily chart versus 10-minute? I used to trade the E-minis on the 1-minute, 3-minute, 5 or 10-minute chart combination. I trade soybeans, cattle, dollar, the current or commodities off a 10-minute chart. When I get ready to buy based upon the 10-minute chart, I flip down to the 5-minute chart to see if it's confirming, and if it's confirming, I flip down to the 1-minute chart to see if my exact entry is at the right spot. That's up to each individual, TJ. Depends on how fast you want to trade. Now, it doesn't take more than a few minutes to go back and analyze a chart pattern, whether you were trading off the 10-minute or the 5-minute, to see which ones work more effectively or whether they work well in combination with each other. Whoops, I'm getting near the end. So here's a scoop pattern. There's a left-right combo. This is our expectation. Here's our classic pattern. There's our fry pan bottom. Notice where it broke out. Then there's our J-hook pattern. What was the prerequisite for our J-hook pattern? A strong price move. So we call this the classic pattern, because if you see a fry pan bottom and a strong price move, get ready for a pullback. And notice how indecisive the pullback is. And then we have another bullish candle. We know that this wave right here is probably going to be the same magnitude as this wave right here. So if I see something setting up like this, I know this is my classic pattern. There's going to be more upside. If I see something like this, where I have a bullish harami right on the 50-day moving average at the bottom of a wedge and they gap it up through the upside, I'm buying. Even though my stochastics are now up in the overbought area, I know this is a breakout. There's my doji gap up through the top of that wedge breakout. This is IBM just a couple of weeks ago. This is our analysis for this. We were buying Sona yesterday afternoon because look what pattern we had. A doji sandwich coming out of the oversold area, closing above the T-line. So now we can use the targets that everybody else is watching. What's our first target? Probably coming back up here to fill the gap. So what did this do for us coming up through? We're buying the stock and or buying calls right at the appropriate time. HJ, if you go to our website, www.candlestickforum.com, I've written 3 books on candlestick analysis. Profitable candlestick trading through Wiley and Sons, and then high profit candlestick patterns, which is probably the one you want to get. And then I've also written a 3rd book, How to Control Your Emotions Using Candlestick Signals. Hi, this is a pattern, a 10-minute chart. For how long do you hold typically before selling? There's a very simple rule, TJ. Javier. If I'm buying, if this was a 10-minute chart and I'm buying based upon a candlestick buy signal, I'm selling usually when I see the stochastics get up in the overbought area and see a candlestick sell signal. This is TLRY. Everybody is kind of trading this because you can see how it stayed above the T-line, and then notice what it did after going from 30 to 300. This is where we were saying, watch your 10-minute chart. So we had people taking profits up here. And then what's our simple rule of a doji? Look at this long-legged doji. Open lower the next day. What'd that tell you? The selling was still continuing. Now there's our inverted hammer gravestone doji, followed by a little doji gap up. This could go back up. Will it go back up to 300? No, it may only come up here, but that's still going to be substantial. At least we know the direction of what's going on right now. So here's everything built into the scans using Metastock scans. You can see the wedge. You can see the T-line crunch. Notice how they couldn't close it below the T-line. You can see the bobble breakout, which as soon as they hit the 50, they pulled back. Then they broke out through the 50. That's what we call a bobble breakout, giving you another strong price move. So anyways, that's using candlesticks just on one pattern, like wedge breakouts, will dramatically improve your probabilities of not only being in a bullish trade or bearish trade, but in a strong bullish trade or bearish trade. All right, let me, how to control your emotions. Yes, that one was written because if you do what the candlestick charts tell you, which is dramatically putting the probabilities in your favor, now you're making your decisions not based upon your fear factor or your greed factor. You're looking at the chart saying, what is this chart telling me is going on in investor sentiment? What is the use of the 20-day like SMA? Like you can use it. Again, you can put anything on your chart. If it works well, usually the 20-day moving average will work when a trend is in a sustained uptrend. Otherwise, it's the 50, the 200, and I usually use the 34 EMA to help out a little bit more. Yes, candlestick formations are found in stocks, bonds, currencies, commodities, tulip bulbs, anything that has fear and greed in it. My website is www.candlestickforum.com. And it's high profit candlestick patterns, profitable candlestick trading, and candlestick profits eliminating emotions. J-hook is a common pattern. It's not the most common, but it's a very effective pattern that not only tells you you're in an uptrend, but you're usually going to be in a much stronger uptrend than just a steady market uptrend. It trades on, AJ, candlestick signals are not for any trading market or entity. It's for all trading entities. I think they're just in hard covers. Sean, I would guess, and again, this is just a guesstimate because I've traded thousands of trades and I keep track of the profitability, not the percentage. But I would guess that 70% of my trades are profitable. Now, that might mean that some of them are profitable by 0.3%, some by 300%. But the important factor for me, and again, that's why I wrote the Controlling Your Emotions book, is that most people say, yeah, if I got a good positive trading percentage, it'll work. I'll make lots of money. But what candlestick analysis does is not only shows you the good profitable trades, but it shows you to get out of the bad trades immediately. Yes, TJ, I trade options all the time. Remember, options are just a method for buying the underlying entity that you're trading. So if you can analyze that, like we did Sona. Oh, I didn't want to do that. If you can analyze that Sona is doing the right thing, you're buying options or you're buying the stock. Okay, is that you, Jeff? Thank you very much, everybody. Yes, our website is www.candlestickforum.com. The books are there. You want to buy the books off the website because they're about 60% of the price of what they sell on Amazon. So, Jeff, thank you very much. Thank you, everybody.
Steve, thank you.
Yep.
Thank you. If you do want to get some of his books, candlestickforum.com. And I didn't mean to cut you off there, Steve.
No problem.
That was somebody else joining. So,
okay.
in any case, did you have a special offer you wanted to talk about?
Oh, I didn't.
Okay, no problem at all.
I thought we were just showing that the
perfect
signals were on your.
Well, I do want to show those. So,
okay.
Steve, great job today. I really appreciate you coming in and spending some time with us. I'm going to go ahead and make me the organizer again.
Okay. So. All right. Thank you, everybody. Have a good weekend.
All right. So I do want to show real quickly the patterns that we've developed for Steve Bigelow. We don't have a lot of time to go through this, and that's fine. We don't really need a lot of time to actually show that. I do want to make sure I'm sharing the right screen. And I do want to talk to you a little bit about the product we've put together with Steve. What we created with a couple of years of work was our most successful modern add-on, and that's the Steve Bigelow's Candle Profit System 2.0. And what it actually does is it identifies all of Steve's major patterns and a lot of his single-day patterns as well. We're not going to go through all of these, but I want to give you an idea of what this does. So these are the multiple day patterns that we identify. Steve talked quite a few times about the fry pan bottom. We've mentioned a little bit the doji best friend and the doji at the top. And then in addition to that, we have a lot of his single bar patterns. And I want to show you how that looks on a Dow chart. And again, keep in mind, I don't have a lot of time. This chart here is the Dow Jones Industrial Average. The format that I've got it on right here is the monthly format. And what you're going to be able to see is anytime any of those J hooks come in, or the doji sandwiches, or any of those patterns that were on that list, whether it's a bobble pattern, a left-right bearish combo, a cradle pattern, whatever it might be, those will be automatically generated for you. Okay, I'm going to go ahead and scroll in just a little bit here. And you see here, right here, it's identifying this recent J hook that we just had in the Dow. Now, again, this is the monthly, so this was a monthly chart back in July. If I want to go down to a different interval, I just want to show you a couple of different time frames to kind of get you an idea of how this works. If I go down to a weekly interval, you can see there is a bull kicker right here. There's a dumpling top right here. And then I'm going to push it down to the daily interval, just to kind of give you an idea of how this will look. And you'll see right before we had that all-time high in the Dow last week, we had generated both a fry pan in an uptrend and a slow curve. Here we've got a bull kicker. Here we've got a slow trend. Now, I know that those of you that are not familiar with Bigelow and Steve Bigelow and the patterns, you might not really understand what this slow curve is, or a fry pan or a bull kicker. And so one of the things that we've done in this add-on is we actually have an expert commentary that's available for you that you can actually, I'll just go ahead and show it real quick. I'm going to go ahead and open up our expert commentary window, and I'm going to put this little pointer on this slow curve that happened just about, precisely on 9/18, right before that huge run up that set the new high, the new all-time high. So when I point at that, it actually says the slow curve produces a long trading opportunity as the slow upward curve raises support from the T-line. Exit on any price close back below the T-line. So it's not a lot of text, but it's basically saying, okay, here's what the opportunity is. Should go ahead and go long. And then if it closes down below the T-line, you go ahead and get out of that opportunity. To give you an idea of how the fry pan looks, here we have a little bit, not only do we have a fry pan here, but we also have a slow curve. And it's going to, in very simple, easy to understand English, it's going to explain that pattern to you with the power of Metastock. Okay. The other thing that I'll show just real quickly before we go on to the kind of the pricing and the next presenter is one of my favorite things in Metastock is the ability to go in and do scanning. So if I come in here, and it's actually on my favorite scans, I can run a market scan against just about any market I want on Earth. We cover about 200 exchanges globally. We cover the Indian market, AJ. We cover London. We cover Singapore. We cover Australia. Almost 200 exchanges. We cover Forex. We cover futures. We get all of our data from Reuters. So obviously they have a huge market coverage that's available. Now, if I wanted to run an exploration and just find some of these patterns, all I would do is just find let's say we wanted to do a J hook or a doji dynamite. I can just go ahead and select that. I can come down here and select from any of 382,697 stocks or futures that are available. But to kind of just run this real quick, what I'm going to do is I'll just do the S&P 500 with a local data list that I've collected. So it runs really quick. And I'll just go ahead and start this. Now what it's going to do for me is it's going to go through 500. Oh, I selected multiple scans here. That's okay. It's going to go through 500 stocks. And it's going to tell me out of those 500 S&P 500 stocks, which ones actually have one of those particular patterns on a chart. In this case, it was a left-right bearish breakout that happened on Friday for both Concho Resources and General Dynamics. Ordinary. That's probably what I should show you because we're at the top of the hour. There are some questions that are coming in chat, but I want to respect the next presenter's time. So I'll just go ahead and show you the different patterns that we're identifying. So these are all the patterns that will show up on your chart. They show up automatically. They'll give you explorations. They'll give you those commentaries I was showing you. And then you also have the ability to scan through that. So by far, this has been the most successful add-on that I've released in the 13 or 14 years that I've been working so closely with the add-ons. People love it. It's one that I use every day to kind of help me find trades when I'm going to look for the J hooks and that kind of stuff. And I'd recommend that you try it. We also offer it on a money-back guarantee. So how that works is it's an add-on for Metastock. It's only a one-time cost of $499, which I think is ridiculously cheap. You can buy it today as a summit price of $399. It includes a 30-day money-back guarantee. If you have version 1, there's upgrades available for that. And if you don't have MetaStock, we will throw in a free trial for that. Okay? But it's $399. You just pay for that once, and you're good to go. So we do have some sales guys that are here. You can call them at 800-882-3040. You can also visit us online at metastock.com/sales chat. Now, I do want to reiterate that was a very, very down and dirty demo. I will be sitting here answering the questions that are coming in. I see a lot of them. I do want to respect Steve Primo's time, who's coming right up. So I'll answer your questions by chat. And we'll also be spending some time in MetaStock today, showing you how that works. Before we get to him, I do want to talk a little bit about this Trader's Toolbox that we have. The Trader's Toolbox includes all of the add-ons we're going to talk about. We've just talked about Steve Bigelow's. We're going to talk about Joe Duffy coming up in about an hour here. Adrian Mance is going to be here, and we're going to talk about a Nichimoku Master. All of those add-ons separately would cost about $1,896. We're going to put together basically a bundle package today that allows you to get all 4 of them. 2 years of Stocks and Commodities magazine, which is like a $149 value right there. We'll give you 3 months access to our award-winning MetaStock platform, 3 months of MetaStock Zenith. We'll give you, I'll be doing a boot camp next week to kind of help you get started with MetaStock, show you how to put everything together. That's next Thursday at 6 p.m. We'll give you training. We actually have a one-on-one installation support. So normally all that stuff put together would cost you $2,596. The Summit special pricing that we're going to do is $1,596. So give us a call at 800-882-3040, or you can chat online with us at metastock.com/salespchat. And like I said, we're going to be talking about MetaStock all day here.